This is the Daily Market Rundown live from the Tradelo trading floor. It's March the 7th. Some highlights from today's show. Non-farm payrolls is in play. Powell set to make comments, and Bitcoin has another leg lower. Good day, traders, and welcome. It's a Friday. Happy Friday. It is, of course, also non-farm payrolls Friday. We'll get into that in a moment. Just looking across the board, I think a good place to start is to talk just about the general sentiment. And the best place to look at that is, of course, at the Mag 7. If we look at week to date, we've got Nvidia now below those deep-seek lows, sitting around $110, down 12% on the week. And we've got Tesla down 10% on the week. We've got Amazon down 5.5% on the week. And even Meta, the golden boy Meta, the best performing Mag 7 all year, is down 6% this week. Now what this means is that sentiment rarely is in the toilet, and that's not going to suddenly flip on its head. It's not going to suddenly change until, of course, we do get some confirmation that this new narrative, this new slowdown, stagflation narrative gets squashed. Now, of course, that potentially could happen today. Of course, it could also amplify today. So with that in mind, let's turn to our first topic of today, and that's all about non-farm payrolls Friday. Now, how do we go about this? Well, look, non-farm payrolls is notoriously very, very volatile, but it does present a number of opportunities. And of course, the key one to focus on today is not so much the unemployment rate. Okay, we know the labor market is strong. Of course, if suddenly unemployment ticked up to 4.3%, that will raise a few eyebrows. But we know that the labor market is still relatively solid and that there's still a healthy number of jobs in the US economy. So what's going to be the key focus today is two things. One, I'll start off with the easier one and we'll move on to the more nuanced one, is keep a close eye on the earnings year over year. We did see those tick up quite aggressively last month. And again, why this is important is just simply there is a little bit of stagflationary fear coming through where we see slower growth as well as inflation that is stuck well above the Fed's 2% target. So keep a close eye on that. The expectation is for a 4.1 read. The high end of the expectations is 4.2. Should that come out 4.3 or higher? Okay, that is going to just add to those stagflationary fears. So that's the first one. The second one then is, of course, keeping a close eye on the actual headline print, the non-farms print. Expected is 160. There is a massive range on this between 30 and 300. This is not normal. Okay, if you go and look traditionally, non-farms ranges are normally around, call it 60, 70K from the median. So there is a very big mixed bag of estimates for this. And that's because of a number of different things, weather, layoffs due to Doge, all sorts of number of reasons why this number has got a very, very wide range of expectations today. The key thing to take away is, of course, we get a really good number today, and that will dent some of this narrative that we're about to drop off a cliff that we've seen in the last 2 weeks. However, we get a number that's very, very weak today, and of course that's just going to heighten the fears. Okay, now contextually, we'll talk a little bit about context because that matters a lot going into this print today. Contextually, the market, like I said to you, it's expecting a weak print. There is a very high anticipation and pricing that today's number is actually going to come in on that weak side. And that's important to stress and to understand, because if we got a number today like 185 or even 200,000, okay, net 185 is not a significant change. It's not something that, you know, you would look at and you go, OMG, that's amazing. Okay, it's mostly in line. But a 185 against the context of a market that's in the toilet ultimately will be taken very, very favorably. Okay, so it's important to understand that skew. There's a little bit of nervousness on a weak print today, and there's quite a lot of hedging for a weak print. That's important to understand. If you look at the zero-dated options, of course, dealers are very negative, gamma. Ultimately, everyone is hedged for this event today, and of course hedged for the near-term, sort of continuation of this downtrend. So there's a lot of expectation for this number to come in weak. Now, what number is weak? What number is strong? What's a number I would trade off of? Well, look, I think anything less than 75K, I think that is going to open up a lot of questions as to the US economy, the state of the US economy, and how quickly it's deteriorating. A negative number, all bets are off. The Fed will be cutting in March. So you see any negative print today, don't forget Powell is coming later on the ballot, and he will open up the door to a March cut. Remember, the Fed is very much two-sided risks, which is they will not hesitate to cut very quickly should we get a weak print. Why? Well, because they've told us that ultimately the labor market is a key focus for them, and should they see material weakness, they will remove more of that restrictive policy they think they've got. Okay, so sub 75, it's game on. Front-end bonds will drive up the page. You will see the curve steepen quite aggressively, and of course the stock market is going to have a nosebleed day. On the upside, okay, what's a good number today? What's a sort of a number that really does perhaps alleviate some of the fears and concerns of the sudden drop-off and the sudden growth scare? Well, I think anything above 200 today. I think a number above 200, the market's going to like that. The market should stage a rally off of that, more just because the first part of that move is going to come from an unwind of some of the hedges, and then the next part of that is probably going to be a little bit of a squeeze. Why? Well, because like I said, the market is net short. Dealers, of course, will also add fuel to that short squeeze potential trade. Okay, so that's the non-farm payrolls. Now let's, of course, turn our attention to Powell. He comes a little bit later on the day, 5:30 London. And this is the first time he's speaking since his address to Congress. And ultimately, I think the key takeaways to focus on today is, will he give us an update as to the implications or his thinking around what these tariffs are going to do for inflation? Okay, we have, of course, seen over the last 4 weeks inflation expectations in the US were ramping up. Okay, they were very significantly ramping up. We can see a number of the surveys are pointing towards consumers thinking inflation is hot. Okay, now, of course, the Fed pays very close attention to this. If they feel that inflation expectations are becoming unanchored, they will ultimately want to get out in front of it. However, again, there's so many different risks being presented to the Fed right now that I suspect they're probably going to just want to get to the meeting that, of course, comes in 2 weeks' time. Now, very, very important, like I said, the meeting comes on the 18th, the meeting statement's on the 19th, but as of this weekend, Powell will go into blackout. So this is the last opportunity for a Fed member to give any signaling for March. And like I said to you, if that number comes in less than 75, don't be surprised to see Powell open the door to a March cut. Okay, they've been very adamant over the last 12 months that they will not hesitate should the labor market weaken. You get a number less than 75, they are going to respond, and they're going to do so forcefully. They're not going to hang around to see the job market suddenly drop off a cliff. Okay, now of course what that means is if we did get that signaling later on in the session, equities may well find themselves down 1.5% to 2% on the day, but should we get that signaling from Powell for a March cut, don't be surprised to see a little bit of a short-term sort of rally, just as some of those shorts get forced out of the market. Okay, and then of course, just in terms of the stance, it's very important to know his most recent stance. He told us they can ease policy if labor market unexpectedly weakens. Okay, they're not expecting a 75 print today. Should we get that? Should we get an unemployment rate at 4.3%? Okay, that is going to open the door to a March cut. And then of course, they have told us that if there was a concern around inflation, they can maintain the current policy restraint. In other words, at no point has Powell ever suggested that they could consider higher rates. Okay, it's always been a case of we think we're restrictive, meaningfully so, and we can keep them meaningfully restrictive for some period of time if inflation doesn't come back down. Okay, so that's the general stance. He leans somewhat dovish, and then of course he's also told us that policy is very well positioned to deal with risks. Okay, should he change that? Should he say, well, policy is somewhat positioned or somewhat able to restrict, or he says policy is currently not meaningfully restrictive, it's just holding back the economy. Any adjustment to the wording during Powell today will of course be taken very, very hawkishly from the markets. Okay, so a number of things to pay attention to in terms of when Powell speaks, but of course we have to first get through the non-farm payrolls print. Now, I spoke a little bit about context. I think this matters absolutely. And there's two reference points to pay attention to in terms of playbooks you can lean on. Now, the first thing to point attention to is context, okay? What you can see, yesterday's close in the VIX is the highest point effectively this year. We closed around that 24.75, call it 25. It's the highest close this week into non-farm payrolls. Okay, we've closed at the lowest point of the year as well yesterday. So we are really much going into this non-farm payrolls with a very, very negative sentiment. And that's what I was just sharing with you earlier, is that the market is expecting a downprint today. It's expecting a bit of weakness. Now, one of two things happened today. Should we get a very, very weak print, a sub 75, okay, all bets are off. This VIX is most likely going to spike its way up towards that 30, perhaps even higher. Okay, a number of things can happen. I don't really want to guess what happens, but I do suspect we will have a very, very aggressive move to the upside in the VIX initially, and then of course a number of different things can happen over the course of the day. But less than 75,000, all bets are off. The market is going to price in a very aggressive slowdown and perhaps some form of a recession. So many things can happen that I don't want to anticipate what happens. But what I do want to share with you is effectively what happened in the August non-farm payrolls last year, because that's the sort of the last time we had a really bad print from the US. This is also contextually at a time when the US data was slowing. Okay, so contextually, we could see the VIX was hotting up. Data had been slowing for some period of time. We can see VIX went from, a downtick of 10s all the way up to 20s pre-non-farms. This is, of course, the non-farms day. You can see we had a very, very big spike up in the non-farms. It did get faded. But Monday they came in and they spiked that VIX all the way up to whatever price you want to call that. Okay? The point is that in a heightened uncertainty environment, should we get a very weak print today, I do suspect we get a very similar play as we got in August. And ultimately, what we got was equities selling off quite aggressively on that. I'll show you that chart in a minute. Now, the other way this could play out, and this is sort of another contextual way to look at it, is very similar to October's 2023 correction. We had quite a nice correction in the stock market. I will show this to you as well. And contextually, this looks very similar, where we've got this little bit of a slowdown in the data happening. We then got a little bit of reprieve. So think of a 185 non-farm payrolls today. Everyone goes, oh, whew, that's a good one. Finally, we let off the hook. Everything's okay. And we got a little bit of reprieve in the VIX. But then, of course, we continued that very aggressive slowdown in the US economy. And, of course, the stock market continued its correction. And then we spiked even higher. Okay, so we could get something very, very similar to that today, where if the number does come in okay, it's good enough, the market could just back off a little bit on the VIX. But ultimately, eventually we did get that full correction in 2023. Now let's look at those charts, because I think there's two very good examples to look at here. This is the S&P 500. And what you can see, that's 2023. This was, of course, that correction before the significant rally we had. And this was ultimately the move that happened into that weakening of that data, that spike in that VIX. Okay, so we came down, we sold off quite aggressively, tested a 200-day moving average, bounced first, extended beyond it, and that was the low tick. Okay, if you cast your minds back to this, it felt like the end of the world. It felt like everything was falling off a cliff. And then in reality, nothing was falling off a cliff, and we had a significant rally thereafter. Okay. If we go back and look at, of course, last year with that economic slowdown, again, very, very similar. We had quite a steep slowdown. You can see a nice steep price drop in the S&P 500, a steep correction. We had an acceleration through the 50-day moving average. Eventually, it bottomed out, and everything was hunky-dory with 1 month later. Okay, we had retraced the entire move, and then the rally, of course, continued. Okay, so very, very similar. Okay, two different types of corrections going on back in 23 and, of course, August last year. I think this one's a lot more similar to August last year, where the market got to very quickly to work pricing in more cuts, some degree of a recession. And again, note contextually, we're right at that 200-day moving average. Okay, so we've tested that 200-day moving average yesterday. We've had quite an aggressive sell-off into that 200-day moving average, which is why I said to you at the beginning of the stream, should that number come in 175, 180, okay, that is going to ignite a little bit of a short squeeze. I suspect there's going to be a lot of shorts scrambling, and we will get some sort of a corrective type move or a dead cat bounce in the next week. Okay, so have a look at that chart. Definitely a couple of things to pay attention to. But of course, one final note, should we get that stinky number? Fine, we are quite sold off. We have near-term indicators are very much oversold. But again, oversold indicators can go even more oversold. Okay, stinky number today. Don't be surprised to see us drop even harder. There are no real levels. Okay, I think with VIX at 25, you do not want to be providing liquidity. You do not want to be Braveheart and sit there providing bids to the market. Absolutely no reason for that. Okay, weak number today. Step out of the way if you're not going to sell it. Don't go and buy it. And then finally, let's turn our attention to Bitcoin. I think some fantastic news overnight. And I think this is a market that is now in play for a another drop lower. What ultimately the government's done is they've now sort of given us a little bit more information as to what they're going to do in terms of their Bitcoin reserve. I think it is quite interesting that they've adopted a Bitcoin reserve, but I think the key takeaway from it is that ultimately they're gonna have a budget neutral reserve, which means they cannot use deficit spending, they cannot use fiscal deficits to ultimately buy Bitcoin. Okay, moreover, it must be self-funded. Okay, so there are a number of ways they can do it, and we'll go through those as options, but ultimately, at a time when the US government is trying to get debt to GDP back down from 6.5% per year, it's going to be a very tall order to see how they're suddenly going to buy any kind of Bitcoin in any kind of size in the near term. Okay, sure, this could be something they start to look at perhaps next year or the year after, and long-term, fine, this will act as a bit more of a stabilizer in Bitcoin, but until they're buying any meaningful amount, I don't see this as a support to the market. Okay, it's news, of course, but it's not a support to the market in the way that the market expected. Okay, and that's the important part to stress, because this rally up was that reignition of the Bitcoin reserve coming. We've now, in essence, sort of put that to bed. Everyone kind of knows the details of it, and the understanding is it's not coming anytime soon. Now, structurally, okay, this is not the way a market forms a bottom. Okay, this is effectively the market saying, I want you to test me, and it's going to be tested in the near term. Today's low gets taken out. Should we have a bad non-farms? 84s go. I suspect we're going to very quickly make our way back down and come in somewhere towards that Trump breakout area. Okay, keep in mind, S&P, NASDAQ, they've pretty much erased, even the dollar, they've erased the Trump rally. Bitcoin's the last man standing in terms of erasing that Trump victory. We can see that sort of started around that 66,000, and I suspect we're going to be getting there in the near term, particularly with where sentiment is right now. Okay, so keep a close eye on that. It's not that I'm bearish Bitcoin, it's not that I don't think Bitcoin has got a future, it does, but it is a market that is likely to stage another drop lower in the near term. Now, I did finally say that there is a way they can buy Bitcoin, and there's two ways they can do it. One, they can do a little bit of a Michael Saylor, where they can start issuing Bitcoin bonds ultimately and have investors buy the bonds, and ultimately those bonds are linked to the performance of Bitcoin as well as a yield. So they can follow a very similar model to what Michael Saylor's done. But again, I don't think there's the appetite for it. Okay, keep in mind right now, there's concerns around Japan and China dumping US bonds. Who's going to be buying these Bitcoin bonds? So I think that's not something that's going to come anytime soon. Plus, there will definitely be some regulatory requirements there. And then, of course, on the other side of that is they could also swap or liquidate some of their gold. And I think this is, again, something that's, of course, doable. It's possible, but it's just not a priority right now. Okay, I appreciate a lot of you might trade Bitcoin, and I appreciate you hodlers and bodlers, and you believe in the future of it, and I do too. Okay, I think Bitcoin is here to stay, but we have to be sensible about this. There is no demand coming from the US government anytime soon. No meaningful demand. Okay, and that's the key thing to take away from this little segment on Bitcoin. Okay, let's then wrap up. Of course, this is the end of another very, very volatile week. There's going to be a lot going on today. Okay, today is very much got all the potential to be a lot of things to do, but at the same time, it could also be a bit of a damn squib day. Okay, I think the key thing today is keep it tidy. Make sure you know exactly what numbers you're going to trade off of, and just remember, non-farms volatility is very good. It brings certain plays into play, so you don't have to rush in like a headless chicken. Make sure that you do manage that risk always. Okay, with that in mind, of course, good luck out there. Manage that risk. Go make some money.